Hey everyone, welcome back to the channel. If you've been following precious metals, you know last Friday, January 30, 2026, was absolute chaos in the silver market. Silver futures on COMEX plunged over 30 to 36% in a single day, from a record high around $121 to $120 per ounce down to the $74 range. That's one of the biggest single-day drops in history, rivaling the infamous Silver Thursday crash of 1980 with the Hunt brothers. Gold got hit too. Today, we're diving deep. What exactly happened, why it crashed so hard, how it compares to 1980, and whether the shorts have truly won. Stick around. To understand the crash, we have to go back. Silver had an insane run through 2025 and into early 2026. Prices rocketed from the 30s to over $120. Why the rally? Massive industrial demand. Solar panels are a huge driver. Silver is essential for the green energy transition we're seeing. Then you have EVs and AI data centers. Silver is used everywhere in high-end electronics. The world's tech transition is built on silver. On the other side, we have structural supply shortages. Global mine production has been flat or even declining for years now. Refineries are struggling. Western mints even suspended bullion sales because they simply didn't have enough physical metal to meet demand. COMEX and LBMA vaults were drained to historic lows. When you have high demand and no supply, prices can only go one way. Physical premiums were exploding in Shanghai and India. People were paying $100 over the paper price just to get their hands on silver. It became a classic momentum trade. Retail and institutional investors were piling in, using heavy leverage to catch the moonshot. By mid-January 2026, silver hit all-time highs around $121. Everyone was talking about $150, $200, even $300 targets. But parabolic moves like this almost always end badly. The bubble was stretched to its absolute limit, waiting for a pin. Fast forward to last Friday. Thin liquidity in the afternoon session, the classic trap. And then, boom, the knockout punch landed. The big trigger? CME margin hikes. They switched to a percentage-based system and hiked silver margins sharply to 16.5%. That's a massive increase in required collateral. In a leveraged market, this forces mass liquidations, especially for the longs. Then came the macro catalyst, Trump's nomination of hawkish Kevin Warsh as Fed chair. Markets sensed a tighter policy ahead. The dollar surged instantly. Safe haven flows reversed as the narrative changed. Gold fell, but silver's volatility amplified the pain. Longs started booking profits after the record run. It turned into an avalanche as trading algorithms kicked in with cascading sells. Trading volume spiked to over 369,000 contracts, equivalent to billions of paper ounces. But the buyers were nowhere to be found. Shanghai and India followed suit. The physical premiums that had been so high collapsed to zero or even negative in minutes. The result? Silver settled around $78.53, down 31.4%, the biggest daily dollar drop ever recorded for the metal. This feels straight out of history books. In 1980, the Hunt brothers tried to corner the silver market. Their failure was legendary. They amassed huge physical and futures positions, driving prices to $50. But then COMEX hiked margins by 50% and banned new longs. Silver crashed over 50% in days. The Hunts went bankrupt and faced years of lawsuits. It was the end of an era. The similarities today are eerie. Extreme leverage and thin liquidity combined with exchange intervention to crush the longs. But here is the big difference. 1980 was about one group trying to corner the market, a single point of failure. 2026 is different. Today's move is driven by structural demand. Green energy, AI, EVs, these aren't speculative plays, they are real industrial needs. We have chronic supply deficits that aren't going away. COMEX can't simply legislate away the global need for silver in our technology. As of today, February 2nd, silver is trying to stabilize. We're seeing some rebound attempts around the $81 to $85 range. But don't be fooled. Volatility is still extreme. Trading is thin, and the market is watching every move from the big banks. The bear case? More margin pressure and a stronger dollar could push silver down even further, maybe back to the $50 or $60 level. Some analysts warn this bubble has more room to pop. If the hawkish Fed narrative sticks, the shorts might have more room to run. But the bull case remains strong. Fundamentals haven't changed. The supply deficit is projected to widen even further this year. Physical demand from India and China is still tight. ETF inflows haven't stopped, and mint shortages are real-world indicators. Even some former bears like Peter Brandt are flipping bullish after this crash. They see massive value at these lower levels. This could simply be a healthy correction after a 250% run. Shaking out the weak hands is a normal part of a major bull market. So what should you do? If you're holding physical silver in your own hands, sit tight. The long-term structural story is intact. But for the paper traders, be extremely careful. This volatility cuts both ways. Don't jump in too early without confirmation. Wait for volume recovery and a clear premium rebound signal before you consider dip buying aggressively. Patience is key now. Overall, this isn't 1980s endgame. That was a corner failure. This is a brutal flush in a structural bull story. Bulls still have ammo. What do you think? Was this Hunt Brothers deja vu or just a violent but healthy reset? I want to hear your thoughts in the comments. If this breakdown helped you, please like the video and subscribe for more deep dives. Hit that bell to stay sharp out there. Thanks for watching. I'll see you in the next one. Stay safe and stay informed. Goodbye for now. Source credits, CME notices, Bloomberg, Mining.com, Yahoo Finance. Important disclaimer, not financial advice. For entertainment purposes only.